Good morning, everyone. This is Bernard Swicky with the Center for Automotive Research. Thank you for joining us this morning. Our webinar will start in just a few minutes.
When do they release claims? Unemployment insurance claims. There we go. 3 million.
All FYI, all of our mics are on. Just wanted to let you know.
Oh, I'm sorry.
Good morning, everyone. Thank you for joining us today. We're going to get going in about 2 minutes, right at 10 o'clock. Thank you. Okay, good morning, everyone. This is Bernard Swicky with the Center for Automotive Research. I'm going to be serving as your MC for the webinar this morning. I'd like to thank everyone for joining us. I know we're all very busy and very much working from home and dealing with things in unconventional ways right now, so we do very much appreciate you taking the time to join us here today. As the industry restarts and contemplates not just the when, but the how in really unprecedented times with complexities that we have to deal with that just have never quite been there in this form before. We thought that this particular webinar, this subject matter, and these speakers would be of real value to the industry. So we're very much thrilled to see the fantastic turnout that we have. And again, thank you very much for joining us today. I do want to mention that the questions today will be at the end of the session. So each speaker will complete their presentation and then we'll do a joint Q&A after the fact. We ask you to submit your questions using the question option on the toolbar, and those will then be moderated, and I'll be the one to ask the panelists all the questions at the end. This seminar is being recorded. Therefore, one, for your own use, but two, it'll be on the CAR website, and you'll be able to forward that to any of your colleagues. But it does, I think, sort of serve as a nice reference in the future as well. I do want to just quickly mention that the work that CAR has been doing on researching the COVID-19 impacts and the steps that the industry must take is largely unfunded. And if you are able to help us fund some of this work, we'd very much appreciate that. There's a button on our website that can help you do that. But we very much do appreciate the support that we've gotten to date. We're very much grateful for that. I want to mention our next webinar, which will be focused on dealerships, M&A, and some of these sort of additional implications of opening the industry after this crisis, and that will take place in the afternoon at 1 o'clock on Thursday, May 7th. And of course, we do always, for many of our events, have sponsorship opportunities, and if that's something that seems like it would be of interest for your company, please don't hesitate to contact Katie Ramsberg, whose contact info is provided on this page. Likewise, CAR's big annual conference that we've been doing for 50+ years in Traverse City, Michigan this year will be a virtual event, something that is very much a new approach for us. It will take place August 4th and 5th, and we will be opening registration soon. We're hoping for about the middle of next week. We're filling out the sessions. Of course, in moving it to an online event, we've had to rehash things considerably, but we're, I think, really keeping much of the flavor and certainly as much of the content as possible that is traditionally a part of this event. We're also exploring myriad other avenues for networking opportunities, sponsorship connections, and basically giving you as much of that traditional MBS experience as we possibly can, given the virtual environment in which we'll be working. So we certainly hope that you'll be able to join us, and please stay tuned in to the CAR website to communiques via email from us as this comes together. And then finally, before kicking off, I did want to recognize two partners that we've been working with on this webinar. Both are members of the Automotive Communities Partnership that I run at CAR. And with any luck, Jerry Zilke from NORAD the Northwest Ohio Regional Economic Development Group, is on the phone right now. It was Jerry's idea to have this event, and it was originally going to be held in Northwest Ohio, and it was going to be more local in flavor. But of course, things intervened, and we have moved the event online. RGP, the Regional Growth Partnership, then joined the conversation, but it's really together with these partners that we devised the subject matter that would be appropriate to address here. We invited all the speakers and so on. So it's because of this partnership that we have the event that we have, and we're very much grateful to these partners. And I also want to thank all of our speakers. You've been gracious enough to stick through multiple reschedulings and shifting from in-person events to online. So thank you very much for sticking with us as we've gone through this. And it really does look like a tremendous event. And so with that, I'd like to introduce my boss, Kristen Gicek from CAR, to give you some of our latest analysis on what we see happening in the industry, and as well as add a little bit of an element of what's happening in the trade environment concurrently with the COVID issues, because we're going to have to deal with all of this jointly as we relaunch production. With that, Kristen, please take it away.
All right, are you seeing my slides now?
Yes, we are.
Okay, great. I'm not, so let me get rid of the presenter window. Okay, great. Thank you, Bernard, and thanks to our partners, RGP and NORAD, for helping us sponsor this event. And you know, the auto industry, we are certainly no strangers to crisis. You know, we manage crisis in our supply chain routinely. You know, from tsunamis and floods and fires and supplier insolvencies and all sorts of things that happen that interrupt the flow of all of the parts to the point of assembly. And you know, people, when they go to the dealership, really want to have a vehicle that has all the parts there. And that really does create quite a challenge for us. But we overcome them. I mean, the BorgWarner tornado that hit their factory in South Carolina, April 13th. There was news yesterday that BorgWarner is going to begin launching production in early May. So you know, we do turn these things around quite quickly, and have well-hewn procedures for dealing this with. But you know, globalization in this world with trade the way it has been, very disrupted, and the COVID-19 crisis just put so much pressure on our supply chain. And that's a little bit of what I'm going to talk about today. You know, there's a lot of threats to U.S. production and U.S. firms with the COVID-19 outbreak. First, you know, when this took hold in China, there was a lot of concern about those automakers and suppliers that were exposed to the China market, and that they would be differentially impacted. And a lot of calls, at least to our office, about, well, which models, which vehicles have the most Chinese content. The truth is, every vehicle has some Chinese content, and we were all, you know, just waiting for that disruption to hit our shores, and I don't think that it did in large part, and before the COVID-19 crisis took hold here. You know, it moved from China to Europe and then here, and so now we're looking at supply chain disruptions writ large. The health crisis is significant, and one that's being, you know, discussed and worked out, at least between the UAW and the Detroit 3 automakers, and many of the automakers and suppliers are thinking through all of the new procedures and new job design they have to do in order to protect their workers' health as we re-enter the factories and begin production once again. But that is going to continue to be an issue until there is a vaccine or a cure. The consumer demand drop, I know that our speakers are going to talk a bit about this, so I'm not going to myself, but at least very much. But the drop off in March was sharp, especially given that we only had really 2 weeks of really impacted sales. April has looked to be a little more resilient than we thought. There are areas of the country where they're like, pandemic? What pre-pandemic, and the deals are really incredible that automakers are offering, 0% financing for 84 months. Hyundai's brought back their job assurance program. There's just, a whole wide range of consumer experiences right now. And then the financial impacts. The automakers all appear to be in much better shape than they were in the 2008-2009 crisis. There's not overcapacity. They're not in a cash crunch yet. But suppliers are really about to be in that crunch. Suppliers, as you know, get paid on a 30 to 60 day basis after they do and perform the work that they deliver to the automaker, and those 30 to 60 day revenue is starting to dry up as we get into the middle of May. So the restart that we need to see a slow, sustained return to production is really critical to minimizing the financial impacts. Another difference between now and 2008, 2009 is the capital markets appear to be functioning fairly well. Ford was able to go to traditional means and float a bond, raising money on a 50-year bond to borrow, I think at 6-point-something%, in order to loan that out to consumers at 0% and fund the rest of their operations. So, the financial impacts, it really depends on how much longer we're in a zero revenue situation and how smooth that restart will be. When we compare 2008, 2009 to the current crisis in the three major automotive markets in the world, China, the Chinese market was not as large in 2008 and 2009 and was relatively insulated from the Great Recession. They had a very sharp drop-off in early 2020 and a sharp return. That has since sort of mitigated, and the thoughts for April is that, that V is starting to widen out a little bit. In Europe, we're seeing a sharp downward trend and very similar to the sales trend that they experienced in 2008 and 2009. And similarly to the US, although our slowdowns in Europe and in the US had been going on for a little while. So that's the picture of what motor vehicle sales have been looking like going into these slowdowns compared to the last recession. There's been a lot going on in trade, and globalization has been a trend in our industry for decades. And I want to just go through a few things here. First, the top 35 automotive parts sources in the world are highlighted here in green. The countries in green account for 99% of all US automotive parts imports, and 70% of our imports come from just 4 countries, 40% roughly from Mexico, and roughly 10% from Canada, China, and Japan. China was number 2 until the trade war began, and they have now moved into the 3rd position behind Canada, but we are certainly dependent on these 3 countries, or these 3 regions, Japan, China, and North America. The USMCA is coming into force this year, so that will change some of the dynamics here in North America. The US and Japan have been negotiating a trade agreement that does not as yet address the automotive situation. And of course, we know China and the US have been negotiating for some time and have ratcheted up tariffs on autos and auto parts between our 2 markets. See if I can get back to here. So there was a movement a long time ago called about the world car. The world car. What is a world car? So, one of the first world cars, or cars that was made in one place and sold all over the place, was the Volkswagen Beetle, the homely Volkswagen Beetle. But it was, as I said, manufactured in one location and sold globally. Corolla, the top-selling car in 1974 in the world, made in Japan, not in any other market, and exported to the rest of the world. And then we had the Ford Escort. I remember this one very clearly as, the world car that was supposed to be the US market getting a vehicle that was made for the European market. But the Ford Escort that was made here was slightly different than the one made in Europe. So there were not those achievements of global scale and global supply chain behind any of these vehicles when they came about. But now I think we really are in a world of the world car. I'm going to pick on Ford a little bit. Ford's T3 platform, underlying the F-Series pickups, there are 4 models available on that platform, and it's made in 4 plants, all of which are in the United States. We do export some F-150s. I saw one rolling down the street in Stockholm, Sweden on a vacation once, and it was very strange to see. But this is primarily a regional vehicle sold here in North America, made here in North America with a largely North American supply chain. When you look at Ford's C platform, the C2, there are 7 or 8 different models that can be based on that platform. It's made in 9 different factories around the world, with only one here in North America in the United States, where the Escape is made in Louisville, Kentucky. Now, if you have a consolidated platform like this with a number of different models and serving a whole wide world of consumers, there are some parts on that vehicle that consumers don't really care about where it came from or what it looks like. And the one I keep thinking about is like a windshield wiper motor. You want your windshield wipers to work, but you may not need a different one for each different market. So your supply chain is going to be necessarily global, and maybe you have 1 or 2 suppliers of windshield wiper motors. Maybe they have 2 or 3 plants around the world that supply your 9 different assembly locations for vehicles made on the C2 platform. This is where we really achieved a world car. And it's where, trade agreements and that move toward bringing things back to the United States may meet some resistance to the efficiencies that have been gained in engineering, in research and development, and in supply chain to leverage one platform for multiple vehicles for multiple markets. So in China, there's been a number of trends going on. Chinese wages have been increasing over time. We've seen the China market start to slow down. And then we saw the ramp up of the tariff war. And this is from the Peterson Institute for International Economics, showing the tariff level for all trade. But of course, many automotive parts, almost entirely all automotive parts and vehicles are now under tariff between the US and China. And the consequences, those tariff impacts on China and the rest of the world. This chart, if the dots are to the right of the center line, that means we've got more trade in those trade codes from China. And if it's to the left, we have less trade from China. If it's north of the center line, the belt line, that means there's more trade from the rest of the world. And below those center line, that means there's less trade from the rest of the world. Our dots, the red dots are cars and trucks that were covered in the first tranche of tariffs with China. And the blue dots are automotive parts categories that were covered in the third tranche. And you would think, things that are under tariff, you may see less trade in those. And that is entirely true. Almost all the dots are to the left of the center line. Those in the bottom left quadrant, there's either weak demand or there's been substitution away from imports to potentially domestic production or just less demand for those types of parts and vehicles. The top left quadrant, though, reflects a substitution away from Chinese imports to imports from the rest of the world. And we did this for a few countries as well. And when you look at this, there's almost an entire substitution from China to Mexico. The Mexico upper left quadrant is very crowded. So if the China tariffs were meant to bring a lot of work back to the United States, there's some evidence there could be either weak demand or return to reshoring. But there's a lot of evidence for a substitution effect for other imports from other parts of the world. I'm not going to go into the NAFTA and USMCA overview very deeply, other than to say that they're moving very, very quickly toward an enter into force date of July 1st. Just this week, there was notification from the USTR to the House Ways and Means Committee that they are moving quickly to set up the interagency committee for labor, the labor attaches that are required, the U.S. Trade representative staff that are focused on labor enforcement. They set up at the Department of Homeland Security a forced labor task force. The Department of Labor is getting ready to issue interim regulations on how the labor value content rule is going to work. There's also a rule of origin interagency committee, and there's some guidance starting to come forth about the alternative staging plans. Alternative staging plans are where automakers can apply for an additional 2 years to comply with these new regulations. If they present a credible plan that they will meet the requirements over the course of 5 years. As we know, we're in the middle of a big economic crisis, and that often rejiggers and reshuffles investment priorities and exactly what automakers' strategies and plans might look like. And we've seen that before. You know, it's common in UAW contracts for the automakers to promise investments at specific plants and a number of jobs and product allocations. And when they did that in 2007, many of those plans did not come to fruition. In 2011 and 2015, when they went back to the table with the UAW, they more than fulfilled the product commitments and investment commitments that they had made. But in 2007, those did not come about. So, you know, over the course of 5 years, things can change dramatically. So I'm wondering, I'm looking particularly at this alternative staging plan about how they're going to evolve that with market conditions and underlying economic conditions. At the same time, there's all this labor stuff going on. There are also interagency committees being formed on around the environmental standards and around the dispute settlement provisions of the USMCA. A lot of this is very new, and although, you know, the auto industry has had transparency into the broad contours of this agreement for more than 2 years, actually getting, you know, rubber meets the road and what do you need to do to comply is going to be very difficult. And it's going to be very difficult in this post-COVID world, or in the COVID world. I guess I can't call it post-COVID because we're not there yet. The automakers and suppliers are going to be working very, very hard to meet a July 1st enter into force date at the same time that they're dealing with all of the disruptions that are coming from the disease outbreak and its relative impacts on our industry. The USTR maintains that they think that enter into force for USMCA will be helpful to the industry as we're recovering from this shutdown, that it will help bring more jobs back to the United States, which over the course of the longer term, all of the evaluations of this trade agreement show that it can bring more work back to the U.S., but it's going to be particularly challenging, I think, in this environment where, you know, the supply chain is particularly vulnerable. Also because, you know, our supply chain in the United States, at least, is made up of many, many small firms. About 78% of our suppliers are firms with fewer than 100 people. And to implement a wholly new trading system on top of all of the other things that we're doing right now is going to be extremely challenging. However, when you take them all together, the core parts rule, the labor value content rule, do incentivize US and Canadian production for vehicles that are traded within North America. One challenge, I think, here is that many of the electric and electrified vehicles are made in the United States, and they have amongst the lowest AALA or US and Canada content. You know, something in the range of 27 to 35% for some of those vehicles. And we sell very, very few of those in Mexico and, you know, a little bit more in Canada, but not that much. You know, to bring a vehicle that's at a very low level of content up to 75% over the course of the next 3 years is going to be very challenging. And that is something that I'm going to be keeping an eye on. So I've been asked, like, what does the auto industry look like when we get back and when we're recovering? As you know, we're going to talk, I'm sure, today about some of the procedures that companies are going through to bring their workforce back, and the slow ramp up that we're facing. But I really see there's going to be 3 main options for the supply chain. The first is there can be some reshoring. Reshoring may be happening anyway due to economic incentives, the higher wages in China, for example, or the USMCA that's requiring higher content here in North America. But we can start to see some reshoring, not only because of the risk of the disease, but other factors as well. Diversification would be another way to approach this, and you can do both. You may diversify even within your reshoring. Having many eggs in many baskets helps the automakers and suppliers manage their supply chain. And if you had all of your suppliers in an area that was hit by a natural disaster or disease outbreak, you'd be relatively more crippled than your competitors who may have a more spread out supply chain. So diversification and maybe maintaining a very wide global footprint in order to balance those risks in the supply chain. And then finally, I think some may take a status quo approach where they already have a very global supply chain, and there may be tweaks along the edges, but not much change of reshoring or further diversification. We can see some suppliers may choose and automakers may choose to keep going in the way that they have. How will manufacturing change? Here again, I think there's three things to consider. The first is automation, and this is happening anyway, and has been happening for decades. But I think we will see an acceleration of automation as we reshore work here. Automakers and suppliers have been struggling to find workers anyway, and in a post-pandemic kind of world, robots don't get sick. Robots can work in close proximity to each other relatively, and can continue production. And that also negates some of the advantages of low-cost countries. So, increasing automation is likely to accelerate in this period. The auto industry has also benefited greatly from implementation of the Toyota production system or lean manufacturing systems. One of the highlights of lean manufacturing is its efficiency. The efficiencies, however, may cut against resiliency. So I'm thinking that there could be some movement there to plump up our lean manufacturing systems, to put a little bit more buffer in our inventories, to put a little bit more time and length in those supply chains to make sure that production is maintained even when there are stressors on the network in some areas. So plumping up lean could be a trend here as well. And then finally, consolidation, which has been going on anyway. Some of the big bets we're making on technologies are being made jointly. You've seen, GM and Honda are going to co-produce a vehicle in a GM factory. Volkswagen and Ford are tying up around electric vehicles. There's a whole ton of joint partnerships and joint partnerships and investments, and just all kinds of tie-ups as we're pursuing automation, electrification, and many other technology developments. And no one can do all of those alone. In a cash-crunched world, I think we see more of that. And in a world where there are going to be additional supplier insolvencies, merger and acquisition activity is going to pick up quite a bit. So those are some of the big trends I see in manufacturing change. With that, I'm going to end my presentation.
Okay, Kristen, thank you very much. For our next speaker, we're going to turn to Paul Traub with the Detroit branch of the Chicago Federal Reserve Bank. The idea being that Paul's work really deals as much with the overall economy and some of the framing factors that we have to deal with as all of this happens. So with that, Paul, we see you're sharing your screen. And we do also see your webinar menu. So if you could just click, make sure that the presentation itself is front and center.
Okay. Let me take this away. I'm sorry.
No
How's
problem.
that? Is that better?
It's still partial. It's partially obscured.
Okay. How do I get rid of it? Do you know?
There it is. We got it, Paul. You're
Okay.
good.
Rock and roll. All right. Well, thank you for inviting me to attend and actually present. I have to start with my normal disclaimer, as I always do, that I may make some comments and they may not all reflect the views of the Federal Reserve or the Federal Reserve Board. So I keep that in mind as I move forward. I'm going to go through my presentation as rapidly as possible. And I have a number of slides, so I set my little timer so that I can keep track of my timing. So real GDP for the first quarter, we finally got numbers. They just came out yesterday, fell 4.8% in Q1 2020. That's on a seasonally adjusted annual rate basis. That's the largest quarterly decline since Q4 of 2018. And it with large declines in personal consumption expenditures, private domestic investment, which were somewhat offset by net exports and government consumption, although the net export we'll talk about later. University of Michigan's April release of its Consumer Sentiment Index had its largest single month decline since October of 2008 to its lowest level since September of 2011 on fears of a worsening economy. And of course, the pandemic. Business and fixed investment declined 5.6% in the first quarter, with non-residential investment falling 8.6%, largest decline since Q2 of 2009, while residential investment actually increased 21% on an annual basis. U.S. trade deficit fell $83 billion because imports declined 15%, while exports just declined 8.7%. And labor markets suffered their largest declines in history, with over 26 million workers filing for unemployment in 5 weeks. With today's numbers added in, another 3.8 million, so it's near 30 million people have filed for unemployment. Put that in perspective, in 1929, the Great Depression, the population in the U.S. was just 122 million people, and the labor force was only 49 million people. And only 47 million people, 48 million people employed. So in perspective, that's you can kind of tie that together. The next slide shows you that 4.8% decline. I apologize for my dog. That 4.8, breaking it down to C plus I plus G, investment, consumption, personal consumption, private investment, net exports, and government spending. You can see that personal consumption expenditures contribution, so these should add up to the 4.8. So the contribution from personal consumption investment was a minus 5.26%, minus, say, 1% for private investment, but positive contribution 1.3% from exports. And of course, government continues to grow and add another 1.3%. So that adds up to your 4.8. The U.S. economy, as you know, is basically driven by consumption. So the consumer is worth about 70% of the overall economy. So the attitude of the consumer is very important. The University of Michigan consumer sentiment numbers fell to 71.8%, its lowest level since late in 2011. When I talk about the consumer, I always look at ability and a willingness of the consumer. Ability is, do I have money? You can see that in the bubble in real disposable income growth in 2018 and 2019, which was the tax cut. Of course, that wore off because you're looking at year-over-year changes. And so now we're looking at that falling off. So leading into where we are today, the consumer's income level, their feeling of ability was already starting to fade. On the willingness side, I like to use the stock market kind of as a proxy. I have money, but how wealthy am I? Do I want to spend that money? I'm not going to spend the money out of the market, but it does give me an attitude that I'm doing well. And as we all know, the stock market fell precipitously and has corrected. Some analysts feel it may be still somewhat overpriced. Analysts that I talked to indicated that the market may have been as much as 15% overpriced at the time of the pandemic. So some of that decline was cyclical or kind of resetting the market. And right now we're probably sitting at pretty close to fair market value on assets. The big issue going forward on how this economy is going to recover, I know we're going to be talking a lot about making automobiles and recovering the manufacturing, but you're not going to sell them to anyone if people aren't comfortable to go out and consume and aren't comfortable. And a University of Michigan survey shows that of all households, they put health in front of the fact that they have to isolate, and in front of the fact of personal finances. Health is primary to most consumers. So I think this is going to be part of the issue going forward as we try to bring the economy come back online, is how comfortable our consumers going to be in getting re-engaged in the economy. As for Purchasing Manager Index, I use this to kind of take a flavor of like the Consumer Attitude Index. So how are purchasing managers feeling? For the ISM index, when you look at manufacturing composite, had fallen below 50. So, and it had been falling for quite some time. You can see both indexes were falling. However, the composite had increased. And so that was starting to set itself. But we were starting to see a slowdown in the economy as we were leading into this pandemic in a lot of areas. And we'll talk about that as we go forward. So we look at real private domestic investment. There's your decline, 1% decline of 0.96%. You can see most of that was in non-residential. The residential contribution to that was actually very positive. As I said earlier, it grew. And inventory change was a part of it. I want to point out, as Kristen was talking earlier about trade and the impact of tariffs. If you look back in late 2018, when the tariffs were starting to go into place, a lot of companies started to pull inventory, buy things from abroad before the prices went up, and you had a big spike in inventory change. And actually, when you look at the private investment side, it had actually started to slow down 4 quarters ago as businesses were starting to contract, slow down. Inventories were changes as they were burning off inventories, and especially in the non-residential investment side, you can see that there's 4 quarters where they were negative, and with the last quarter being the worst. The residential piece started to pick up a little bit late in 2019 and early part of this year, and some builders referenced the good weather, so an opportunity to start homes because weather was so good. There wasn't the snow, the ice, the sleet that we've had, so that was kind of a weather phenomena that might show the numbers higher than what they otherwise would be because of seasonalization. Now we'll go through a series of charts real fast that kind of show you the hockey stick upside down. Here's industrial production, fell 5.4% on a month-over-month basis. When you look at what happened in automotive production, it was tracking right around 11.5 for the US, fell 7.2%, so that's a 36.1% decline in auto production in the month of March. We look at housing starts. While they fell, they were still positive. You look at the 1.2 million housing starts in March, that's pretty close to what a lot of analysts feel is normal. You can see that kind of bubble there. Again, I think that part of that might be seasonalization and the timing because of the weather. But we need about 1.2 to 1.5 million houses to allow for population growth and new entrants into the labor force. So you can see that that number, though it fell 22%, is still not really off the charts or abnormally low. On the trade side, as I mentioned earlier, although it added to overall GDP because of the decline in the trade deficit, overall trade was negative by 12.6%. So this talks to what's going on in the world. I don't like to look at just imports or exports or the deficit. You want to look at how well are your trading partners doing. And a lot of what the incentives had done, the tariffs had done, is slowed down trade in imports and exports into the US. So overall trade was contracting. So as we were leading into this pandemic, the globe was actually slowing down. China was being hurt. Other trading partners were being hurt. So their economies were somewhat weakened as we entered into the pandemic. We look at payrolls and employment hit very hard. We lost 701,000 jobs in March on the non-farm payrolls, which was pretty dramatic. The largest decline that I can see on record. Again, you got to go back through time and remember that you have different levels of employment based on population and growth in the labor force. But this is a historic decline, and that doesn't include what we're going to have coming forward with the new 24 million or so unemployment claims that haven't yet been worked into this unemployment number, which just jumped up to 4.4%, very close to what we call the NAIRU. However, that number will probably go higher. One of the things that's going to change that is what happens to the labor force. If the labor force doesn't fall, if the labor force falls and people leave the labor market, you may not see the rise in the unemployment rate that's consistent with the job loss that we might experience over the next few months as we slowly start to bring the economy back. You can see the unemployment claims and continued claims. Now, this doesn't include the latest number, which came out at 3.839 million today, just minutes before we went on stage. So you got to add all that together, and that 26 million jumps to close to 30 million unemployment claims so filed in just since March 14th of this year. And as I mentioned earlier, the impact on the labor force on the unemployment rate will be what happens to participation rate, which was growing, and actually had reached levels higher than what the Congressional Board Budget Office thought it should be for their predictions or forecasts for what our potential growth is. But you can see that it fell pretty radically in March, and we might see more of that as people start to leave the labor force in fear of catching the virus. And there was information yesterday coming out from Georgia or other places as to whether or not you'd still be eligible for that unemployment claims if you were called back to work by your employer but decided not to go back because of health concerns. So people may just choose not to go back to work. That would lower the labor force. Inflation expectations still remain below our 2% target. As you can see, 1.49%. This is the 5-year minus 10-year TIPS, which is inflation Treasury inflation protected security. So this is kind of a market expectation of what inflation is going to be going forward, well below what the Fed calls as its 2% target. So it allows the Fed to stay very active in trying to help fight off the pandemic. Gasoline and oil prices fell drastically as demand for fuel and oil around the world falls as economies crash. You can see that oil prices actually went negative. People were paying, you were actually paying if you wanted people to take the oil off your hands. But right now it's hitting about $12. And the future prices for oil, the expiring date for the April 20th number was $12 a barrel for the first expire at the end of this month. And as you can look, even 2 years out, oil doesn't get above $35 a barrel based on futures. And for the U.S., that's used to be a good thing, but now it's kind of a bad thing because we produce more oil in the U.S. than anybody in the country. So and we don't make money at oil under $50 a barrel. So you'll see more contraction in investment, private domestic investment in the areas of oil exploration, generation of pipes, those types of things that are used in recovery of oil and until oil starts to come back up. Light vehicle SAAR fell to 11.7. I won't go too much into auto sales, but I do want to point out that that early estimates for April, the number could be as low as 6 million. I don't think I've seen in my career a SAAR that low. And I've been I've been an economist for almost 40 years. So this is pretty dramatic expectation and decline in sales. And even with the sales decline, as Kristen pointed out, there's a tremendous amount of incentives out there. So what I've done on this chart is I've indexed incentive spend comparing 2019 to 2018. And I put the seasonal pattern on there in the little black lines to show that up until this year, we were still following kind of the normal seasonal pattern for incentive spend. But this year, we started to pick incentives up early on. And of course, that April incentive number is way out of line with what we normally would be spending in April based on the natural seasonal pattern. So kind of want to talk a little bit about what the Fed has done. The first thing that we noticed early on in March was what's going on in the volatility. Stock markets, of course, collapsed. And the volatility. So this is the daily change in the S&P 500. And you can see how noisy that was compared to historical average back a couple years or back at least a year. you can see that it's starting to dampen a little bit based on some of the efforts that we've taken. The first thing we did, of course, is lower lending rates or federal funds rate to near zero. So right now the target rate is between 25 and 0 basis points. And we also lowered the prime credit rate for banks down to 25 basis points. So we're very active in lowering rates, and so we are near or at our lower zero bound at what we call. We can't really do much more with rates. So the next step is to intervene with activities. And as I pointed out early in March, so then when you look at what happens in normal markets when you want to trade securities, one of the reasons the stock market really got clogged is that you have sellers that sell in normal times. They sell their securities or their bonds, and brokers or dealers buy them up, and they could hold them or as they look for buyers. And so there's a kind of a pipeline, if you think, going through the system. But by mid-March, that pipeline had gotten completely filled. Brokers couldn't take on anymore. They were too much stock or inventory to take on any more debt or take on any more securities. And then that ties up the assets, these very liquid assets of mortgage-backed securities or treasury securities, which can be converted to cash, weren't able to be traded. And so it clogged up the market. So we got in as quickly as we possibly could, and we did some pretty extraordinary things. This chart shows 4 weeks worth of transactions from the Fed. And I look at September 28th. That was the largest number of transactions that we did in the 2008 recession compared to what we did in this recession. So you're looking at well over $2 trillion in just 1 month or 4 weeks of us getting into the market and bleeding off some of these securities so that we could buy down some of and create more room on the balance sheet for brokers so that these securities could still continue to trade. And I think it's having some positive effect. At least it has on the yield curve, which originally inverted back in January of last year, late March, early January of 2019. We always say that a yield curve is the only predictive indicator of a recession. It doesn't necessarily cause a recession, but it does show that markets are tightening. Banks, borrow short, lend long, so that overnight cost of money is very important, and that spread is how they make their funds. So the actions that we've taken did make the yield curve positive to make a bit of a cushion there for banks and a spread there that allows them to make loans and be more active in the market. So the actions that we've taken seem to have worked, at least in this regard. However, like most past inversions of yield curves, we're going to probably end up in a recession, which the yield curve always kind of predicts. But again, it's not necessarily the yield curve inverting as much as it is some kind of external shock. And this is probably the worst external shock that we've ever seen, at least in our lifetimes. This is worse than World War II. Someone compared it to what happened with Pearl Harbor, but this has been more dramatic than even that. And so following this, and before we entered the market, we have what's called the Financial Conditions Index. The higher the index, the tighter the markets. You can see that we've kind of stopped the growth in tightness, and it's reversed a little bit based on the index that we follow. And the forecasts now for growth show pretty dramatic declines. Of course, the 4.8% is very close to what the blue chip had originally thought it was going to be. They were closer to over 4%. I think their number was 3.8%. So rounding errors, that's pretty close. And then there's this V shape where it bounces back real quick. That bounces back is the percent change, not necessarily the overall economy. So if you look to the chart on the right, you can see if I index Q4 of 2019 to 100, the first quarter of 2020 is about 99% of that. And as you move forward, you don't get back to where you left off until the fourth quarter of 2021. That's using the blue chip forecast. So it's not necessarily a V as much as it's kind of a Nike switch if you look at what's happening to the overall economy, which is quite similar to what happened in the Great Recession. However, in the Great Recession, it took 13 quarters to get back to our previous peak. This forecast is a little more generous in that it only takes 8 quarters. Looking at the virus and it's going to be its impact, these are when states should open. It's kind of scary to me that Georgia is now opening and they should not open based on the Center for Disease Control until after June 8th or later. And this is based on the appropriate amount of contact tracing, isolation of the disease, limiting gathering sizes, and getting the threshold of 1 infection per million residents. So long ways from that in those states, but they're starting to open up already. So the CDD projection of deaths uses contact reduction scenarios, so how we limit the contact of others with the disease. You can see now, based on different levels of contact reduction, where we would be at different points in time. We've surpassed the August 25th, the April 25th number. We're now sitting at roughly 61 million deaths, so that number has already been eclipsed. But if we open up too quickly and allow contact, you can see what could happen going forward with the number of deaths. So this is a big problem, I think, going forward, and I think this is part of the issue of opening up the economy is one thing, but getting the consumer re-engaged is going to be the other big problem. So in summary, the U.S. economic activity suffered an unprecedented decline because of the pandemic. Labor markets are showing extreme stress as companies cut workers and prepare for extended periods of lost revenue. And we at the Federal Reserve have taken extreme actions using a full range of tools to support the U.S. economy in an effort to promote full employment while still managing inflation. And inflation is kind of off the table right now. It's not a concern. With some states still experiencing day-to-day increases in COVID-19 cases, others are looking for ways to reopen their economies, which raises concerns not only from a lot of the doctors and medical. If you follow Dr. Fauci, his comments are the virus is calling the shots, not us. And so if we start to open too soon, without the appropriate amount of contact tracing, isolation, and contact reduction, you may see, rather than a Nike switch, you may see kind of a W, where you see recovery and then resurgence of the disease, recovery, resurgence, recovery, resurgence, going forward until we get through this pandemic. That's my presentation. I'm ready close to my 20-minute mark, and I turn the computer back over to you, Bernard.
Oh, thank you very much. Great job. That was not an easy task. You had a whole lot of ground to cover in those 20 minutes. So well done. And I have to tell you, we've got quite a bit of questions that came in for you in the meantime. So with that, we're going to transition to our next speaker, Jeff Schuster from LMC Automotive, to take us a little bit deeper into what this means for the automotive industry. So without further ado, please take it away, Jeff.
Great, thank you, Bernard, and good morning, everyone. So yeah, as Bernard mentioned, I'll kind of feed on what Paul was talking about, a little bit of what Kristen was talking about, and look at it what we see for the auto impact and what we're seeing so far as we see some data for April, and obviously we're going to have the close in a day here, so we'll see how that plays out. So anyway, I think when we look at it, I'm going to just focus really on what's happening on the demand side of things, and then shift us over to the production impact as well. We'll start with a little bit on the globe and some setup so we can see what's happening in other parts of the world, as well as a little bit deeper dive into the US and North American markets. So I think when you look at the latest data from a selling rate standpoint, we've definitely around the world have a kind of a mixed bag, and this has a lot to do with the time frame of when the outbreak started. Obviously, China started us off, and I think when you look at it from a light vehicle market, China in many ways is a template for how the rest of the world recovers or at least manages through this pandemic. We saw very deep declines in February, and then March showed a pretty strong rebound, down a little bit less than 50%, and continued improvement is expected in April as well as that economy restarts, manufacturing restarts. I'll talk a little bit about that later, and people start to return to what the new normal is, certainly not what normal was prior to the pandemic. I think looking at other markets across Asia, the South Korean market is one that is most interesting. And talking to our colleagues there, they would expect to see a continuation of the trend that we saw in March, which was actually an increase in demand. Sure, we had a pullback in February, very different curve in terms of the COVID cases and how the South Korean government and market handled the cases, flattening the curve very quickly and early. There have been little pockets of outbreaks, but generally have been much more under control, and I think that's reflected in the numbers here. Certainly the consumer didn't have the deep declines, the lockdowns, and you see strong March sales. And we're expecting again to see somewhat of a similar story in April, maybe not quite as positive, but nonetheless not a deep decline. I think when you look at some of the other markets, Western Europe, and I'll bring the US up at the same time here, they're behaving in very similar fashions. You had, at least in March, you had declines that in Western Europe in any case were around 50%. I think when you look at exactly what's taking place in the US, you're looking at a market that is, wait a second here. Can you guys see me and everything okay? I got a very strange notice.
Yeah, Jeff, we can hear and see you just fine.
Okay, perfect. I'll ignore the notice. Anyway, yeah, so when we look at the US market, March was not down as much as initially anticipated, still a decline of about 40%, so not as steep as Europe. I think, again, that had a lot to do with the time frame. Europe locked down faster. You had markets like Italy, Spain, France in a more severe lockdown state than we saw across the major markets in the US. So I think if we take that as a snapshot and we'll look at how that impacts the period going forward. All right, there we go. So I think when you look at overall the selling rate across the globe, so we're going to sum everything back up here. There's no question the market fell off a cliff. If we go down and look at the selling rate, which came in roughly just under 57 million units in March, kind of draw a parallel back here. You've got obviously the lowest rate since the Great Recession and a selling rate that is quite similar to those deep declines that we saw in late 2008 and early 2009. Difference being the magnitude. Look at the starting point. Look where we came from. We were hovering in the low 70 million unit selling rate, and we dipped down into the mid 50s. Here, you know, we're in the high 90s or in the 90 million unit level if you come towards the end of 2008. And obviously we've fallen much steeper than we did during the Great Recession from a global standpoint. So quite a significant pullback in relative terms when we look at the comparison. And as we project that forward, we're looking at things really a couple of ways to look at this. So we've got three scenarios here, plus our forecast. We did not put a W in the case of the presentation here today, but I think what Paul suggested, which certainly is kind of a restart, a rebound, and then additional outbreaks, all of that is certainly possible. So I think when you look at the V shape, this was our initial base case forecast. You know, it really looked at a lockdown period that was first and second quarter, again, different parts of the world in different stages of lockdown, and the social distancing measures and other measures during this period not having a significant long-standing economic impact or cost. We see sales and production starting to get back on and rebound relatively quickly, and the selling rate hitting a low point in April, and then starting the recovery state, getting back into the 80 million unit range towards the end of the year. Go into the U shape, and you'll see our forecast is somewhere between a V and a U at this stage. So we're getting a similar impact of a pretty significant shutdown though through the second quarter instead of a beginning of the relaxation. You've got a much more severe economic impact that has some underlying effect on the consumer's behavior. And again, as Paul suggested, the confidence is really the key here on as a consumer willing to go make those larger purchases. And then the global selling rate taking quite a bit of a more steeper hit and a longer recovery, really not recovering until 2021. L-shape taking a little bit further, a much more severe economic impact, more stringent lockdowns across major markets in the world, and then a much deeper weakness in terms of global selling rate through 2020. And then we don't really see any recovery in the first part of 21, and a very weak recovery, which would equate to only single-digit million units in terms of selling rates through 2021. So when we put that all together, this is what we're looking at. You're looking at a rate here, our base case forecast for the globe, we're at 70 million units. We see about a 12 million unit recovery to 2021. At 82 million units, the original V forecast, this is kind of the shape we had in probably mid to late March. So we've taken about 5 million units out since then for our base case. So we're right now in between the V and the U. And you can see the wide band here. If we were to take you're looking at roughly a 20 million unit band between the V and the L. And that holds really into next year, again, about a 20 million unit band of a pattern that we see. W would give you something, some increase as we progress into the end of 2020, and then we'd see the further decline here that would get similar rates into the 70 or down into the 60 million unit level. So if we take the base case forecast that I mentioned, the 70 million units, and look at the walk from 2019, again, it's about a 20 million unit decline. You can see from a regional standpoint, you've got the major markets making up the declines. Not a surprise here, North America accounting for nearly 5 million units of that decline. Obviously, the US is a big component of that. Western Europe picking up about 4.5 million. You've got the rest of Asia coming in with a 4 million unit decline. China starting to level off, but still in a pretty steep decline at 3 million units. And then picking up the remainder there, South America, Eastern Europe, and then the rest of the world coming in at just under 1 million units. So I wanted to take a little deeper look at the US. So this is looking at the US pattern that we had expected, and this would be similar to that V that we were talking about, the US pattern we had expected at the end of March, and that was looking for a very deep decline as we got into the April forecast here. So a March decline that was stronger than again it came in at. And then in April taking us down, and I think Paul mentioned roughly a 6 million unit SAR. This would get us to that 6 million unit SAR at the end of March is what we were expecting. And then you see a pretty strong recovery, but we don't really get into the periods, or I should say the selling rates that we were looking at until the very end of the month, and very end of the year. And some of this was expected to be pent up demand. If we look at the pre-COVID-19 forecast, relatively stable. Again, you've got some movement and downward pressure, and that's roughly that 200,000 units that we had been expecting, a 16.8 coming into the year before the outbreak. If we then look at where we are currently, so just if I toggle between the two, that's the March forecast. Here we are currently. So there's a couple of things that have happened since March. One, the retail environment has held up a little bit stronger than expected. So as a comparison, so March didn't come in nearly as strong as we had anticipated. And then that deeper decline in April, while it did happen, and we're gonna again see the final numbers tomorrow, but from a retail environment, the retail market, we came into the month expecting somewhere north of a 60% decline in retail sales. And it looks more like 47 to 50% decline. So there had been some improvement in retail sales as the month progressed. Some of that I think is due to the state of lockdown. You had going into the month, you had a few states that weren't, Pennsylvania in particular, weren't allowing any type of sales. You now have a situation where you've got about 40 to 45% of all dealerships allowed to have dealership showroom traffic across the U.S. So nearly half of the sales in the U.S. are allowed to or buyers are allowed to go into the dealership. Obviously, there's social distancing laws, but it's not even just restricted online. The remainder, and that includes now Pennsylvania as of last week, the remainder of the country is allowed to sell through online means. So I think that's contributing to the improvement that we see in April. In addition to that, so the other factor here in the pattern shift, again, I'll toggle here. The other factor in this pattern shift in the widening, I think, so the less severe decline initially and then the widening of the decline over the next couple of months is entirely due to weaker fleet sales. So fleet sales are expected to be down about 80% this month. We see some improvement trekking back, but it's going to be an extremely weak fleet environment, at least for the foreseeable future, and that could have some impact on the overall pattern and the rate that we see at the end of the year as well. So here's our forecast through 2022. Really doesn't make a lot of sense to go any longer than that right now. I think the focus is on this year. So again, looking at that 17 million units last year, we're looking for just under 13 million units this year. There's been a few revisions since the middle of March to get to that 12.9. I think there's roughly 750,000 units of additional risk, and I think a lot of that risk is going to be on the fleet side of the market. Certainly, it will have some impact, the restart and how consumers behave and what their employment position looks like as the year progresses. But again, I think we can take the fact that we've got a significant number of leases that are maturing. Many consumers have delayed those purchases by extending their leases. It's been very easy to do so. So we think that lease extension and those additional maturities that are going to be happening towards the end of the second quarter into the third quarter is going to drive a little bit more rebound. And frankly, I think there could be some upside to this forecast at this point. If there's any good news to take out of anything so far, and we're still in the very early stages here, the improvement that we've seen in April to date, and I think the maturities towards the end of the year, and if we combine that with any type of a government stimulus program, which we believe will happen, I think you could be looking at a market that's not quite as down as we're currently expecting. Nonetheless, the recovery pattern looks about 15 million units next year and about 16 in 2022. And the risk band is obviously a little bit wider just as we stretch out the unknown period. So let's move over to the production side of things. This is looking at the overall production market globally. So global light vehicle production, no surprise here. It follows a very similar pattern to demand, about a 20% decline overall. I think one thing that's consistent, and I'll show you some of the numbers when we look at the US and Europe, one thing's consistent though is we entered the year with a lot of the major markets having an inventory drawdown last year. Some of it was for unnatural reasons, such as the GM strike. You had a changeover in some of the regs in Europe that affected some inventory shortages as we entered the year. China went through a destocking as well. So I think the overall pattern was not a lot of excess as we started the year. And then obviously we hit with pretty substantial shutdowns. I'll talk a little bit about what that means from a restart standpoint. But as you can see, we get a little bit of that inventory back, but not until 2021 when we hit about 83 million units globally. And from a pre-COVID forecast, we're really not expecting to get back to those 2019 levels until 23 or 2024. So from a pattern, this is what the global pattern looks like. So the yellow bars are representing our current 2020 forecast. The gray is representing 2019. And on a monthly basis, you can see each month is now expected to be down relative to last year until we get to December. and you could really call that just a slight increase. It's essentially very close. So April, the low point, we see some recovery as those plants get restarted in different parts of the world. Again, using the China model, I think, as an example of how that restart looks. So North America, before we get into some of the specifics, North America production levels, again, this is taking our most recent forecast with those delays in many of the restarts until mid-May, and earlier expectations of restarts in Mexico for FCA, as an example, pushed until May as well. So this would put us at about a 12.8 for the year. Again, similar risk patterns to what we saw on the demand side, about a 15 million unit 2021, and you can see that track back to what we see normal by 2023. A lot of excess capacity in this time frame, as you might expect. You see utilization below 60%. We see it returning really just to the 70% level. So I think the industry is going to have to deal with underutilized, inefficient operations at least over the next 2 to 3 years before we even get near that 70% level. So just before we get into some of the details of the restart, just a reminder, I think we all know this, but it's obviously the supply chain and how we ultimately get to an assembly plant restart here with the OEM is highly complex. You know, in some of the discussions that we've had with the supply base and with OEMs, you know, this is not a flipping of the switch. I know several manufacturers, both suppliers and vehicle manufacturers, OEMs, are starting crews back to get the plants ready, make sure the operations are ready to bring workers back, to do some of the personal protection equipment installation, as well as put the plan in place for social distancing. So temperature controls, all of that is going to be a new reality as we look at manufacturing. And I think in some of the discussions that we've had, you know, one of the concerns is, okay, you start the assembly plants on date X, whatever that may be, if it's the May 18th or May 11th, in some cases, early May for Toyota and Hyundai and some others. We have Mercedes that went back on Monday. So I think when you look at that restart and you get the assembly going, you obviously need to get the materials all the way through the tier 3s and raw materials through the tier 2s, and then the sub-assembly in the modular plants there, as well as the part plants, engine plants, and so forth at the OEMs. The other positive, I think, when you look at what's happened, not a positive necessarily, but maybe something that we haven't thought about, is the notion that you have, when everything stopped almost immediately. So you do have inventory of some parts. Some were in transit, some were at the suppliers, some were already at the OEMs. So I think from our estimation, there's anywhere between a week to 3 weeks of parts, depending on the OEM. So we can get the plants started and get them up and running, and while the industry as a whole gets started. So let's take a look at what that might look like. So looking at China as a potential model for the restart, this is our current forecast for China. In the monthly change from 2019, you can see that, again, the deep declines in February when they had their lockdown. The easing of that lockdown and the restart got us just under a 50% decline, and we see a further improvement to the April expectation. So you have most of the plants running a single shift right now, and again, I think that's probably the model that we'll see the restart in Western Europe as well as North America. I think when you look at one difference certainly is the length of downtime. So on average, China was down only 16 days. You can see the split there. It was anywhere between a week and a little over a month. But nonetheless, that slow ramp up and that pattern is going to be a pattern that we can expect to play out in Western Europe as well as North America. So looking at Europe and North America, you see roughly the same pattern in general. Again, April being a deep decline, some restart happened in Europe. So we didn't see some improvement, still a 90% decline on a year-over-year basis, but it was closer to 96, 97%. So there's been a little bit of a restart improvement there. And as we look at May, again, similar numbers there, a little bit less than 70% down in both markets. You see North America decline here, roughly 98%. So most of the market was down, as I said, in April, in slight improvement there as we progress forward. So we do see, again, similar patterns at the end of the month, or end of the year, I should say, where we start to get positive and we start to get an inventory rebuild again starting, or at least replenishment towards the end of the year. I didn't put Asia on here, but if we look outside of China, you've got India essentially in a zero state of sales and production for the month of April. Very slow restart expected in May. You've got South Korea and Japan. There had been some shutdowns in April and into May, but those are mainly due to export declines from a demand standpoint in Western Europe, in North America. So inventory-wise, looking at inventory, you've got, again, similar stories here. This is looking at Europe. So this is our proprietary work that we do on inventory and day supply in Europe, and then we're also looking at inventory. And this is Ward's inventory data here. So you have the looking at the U.S. anyway, you've got this normal pattern of inventory build for the spring selling season. So this is following a very normal pattern here. You see the increases in days supply last year as well as this year, not quite as strong. Again, some of that has to do with the declines here due to the strike, but I think as you look at it, the idea was that inventory was going to continue to rebuild and then level off and be ready for that spring selling season. Obviously, that didn't happen with the pullback and the declines. You've got raw inventory levels coming into the month of April sitting at roughly 3.6 million units. So that's kind of where we were back in the fall after the fall selling. So again, pretty low levels. There is inventory out there. Obviously, day supply spiked with a pullback in demand. We would expect day supply to come back down pretty quickly, again, with April not being quite as weak, and expectations for May improvement on top of that likely get us down in this. So we're gonna see and would expect to see some shortages of vehicle types and parts, not parts, vehicle types, mainly pickups and SUVs. In choice across parts of the country as we move into May. We did see something a bit of a pullback, and again in Europe with inventory levels, you see a similar replenishment here. So this had a lot to do with the testing, the emission testing changeover and emissions that changeover that took effect last year. So that had something to do with that drawdown. But some of that increase was anticipated. Again, that's at risk with the plant shutdowns, and why it's extremely important to get those plants up and running. So before we wrap it up here, I wanted to just talk a little bit about some of the launch activity. This is something we've been monitoring on a global basis. So these are the number of redesigns and new entries. You see the spike in the first quarter. A lot of those models have been impacted clearly. If not by delay, the March launches, but a lot of them that were started in the fourth quarter and into the first quarter didn't get out to dealerships across the world as expected, or were just starting ramp up, and those ramp ups were certainly impacted. So, as we progress, we have a pretty level and stable cadence when we look at the remainder of the year and into 2021. But you can see most of these models we see having some impact. So I think when you look at the second quarter, obviously the startup of many of those into the third quarter, some of the slippages, but it's going to be on a priority basis, and we'll talk a little bit about what that means. So looking across Europe, you've got a substantial number of launches this year in Europe. You can see by OEM, you've got a large component of these, 8 of them in fact are BEV models. So again, with the pullback in oil prices, and obviously fuel prices in Europe are much higher than they are even after the pullback in oil in the US, but nonetheless I think we've got some significant BEV launches ahead. There have been some other key models, the Golf as an example example, the Qashqai for Nissan, Audi's A3, and Ford's Kuga or Escape. Certainly very key launches across Europe. Some disruptions already took place. The localization of the Jeep Compass, the Kona. You've got delays to the Audi A3 launch, the Qashqai. So key volume programs have already seen a couple of months of delay, and I think we're going to see more of that depending on how this relaunch and restart goes. Contrast out North America, not quite as many launches from an overall production standpoint this year. We've got a lot of import activity coming. From a BEV standpoint, we've had the Rivian delay, we've had the Ford and Rivian shelving of the one Lincoln product. You've got others, Lucid, Karma, Bollinger, Workhorse, all of those at risk, I think, just from an overall standpoint of being able to get those vehicles launched. Key programs, F-150, the large SUVs for GM, the Rogue, Model Y. We heard a little bit from Elon last night, so he obviously is very keen on getting Model Y production back up and running. Maybe a little too keen, but we'll leave that with him. Delays, some key programs already. All GM large SUVs have been delayed by a month. Cadillac was the last to get delayed. You've got a delay in the launch of the Grand Cherokee, the Wagoneer. Frontier gets a pretty substantial delay for Nissan, pushed out nearly a year into 2021. So again, very fluid in terms of delays and expectations. And we, to be fair, we really don't yet know how this is all going to play out until we can get the plants fully up and running. Looking at how that might play out from an importance standpoint, we do see, at least in North America, using North America as an example, this is looking at the average in delays, and this is only programs that we know of or expect to be delayed. And the average has gone up. It was just under 2 a couple of weeks ago, so we're now at almost 2.5 months on average. We see some of those SOPs in the late second quarter into the third quarter having a longer delay, and obviously prioritization of importance. You have the high important vehicles, and again, those are vehicles that are volume or bringing in cash essentially. So the F-150 is a perfect example of that. You have much shorter delays expected, so just a little over a 1 month average on those programs. And then the Frontier, putting that as a medium importance, really skewed the delay here for the medium. So it's averaging over 4 months, and low a little bit over 2 months. The other aspect obviously is facelifts. When we look at facelift activity, if it hasn't started, expect that to get pushed out. Number one, those don't have certainly as much of an increase on a sales standpoint, and I think there's still a situation here until we get to the other side of this from a case standpoint and a releasing or a relaxing of social distancing and lockdowns. Cash is really what's most important in getting these big programs up and running. So just a final thought before I turn it back over, just to conclude, I think obviously the takeaway here, in my opinion, is things are rough. It's not something any of us anticipated. Things are still very fluid, but I think there are some signals of improvement, or at least declines not as steep as initially thought. So I think if we're going to take anything away from this, is the resilience of the consumer and the industry to get things restarted and do it in a safe way. So with that, I'll turn it back over to Bernard, and thank you very much.
Okay. Jeff, thank you very much. Again, that was a heck of a lot of ground to cover, so we appreciate you being so thorough about that very complex subject matter. Time to switch to our final speaker, Mike Jackson from OESA. Mike's work really deals with the supply base and everything that OESA does, but I think this will take us much more closely to the individual company level and to some of the more direct actions and impacts that we're going to see here. So without further ado, please take it away, Mike.
Thank you, Bernard. Appreciate that. Just want to make sure that you can see what I would like you to see there, the PowerPoint presentation.
So Mike, right now we're looking at your Outlook.
Okay. Try one more time, please. I'm afraid, Bernard, I'm going to ask you to, you could take over there.
Okay.
For the sake of time.
Okay. Bear with me. I'm just going to pull up your presentation. And that'll just take a second here. Okay.
Thank you, Bernard. I appreciate that. Hey, listen, everybody, thank you for the opportunity. And Bernard, thank you for the invitation. What I want to do is just give you a quick outlook here on the market. Obviously, we've heard from some phenomenal speakers already, and so there's a lot of ground that's already been covered. Simply want to give you a quick recap here. The title of our presentation is called Parallel Paths of Engagement. The idea here is that we have to focus on getting through the crisis, and once we weather this storm, then obviously we need to also consider some bigger issues and some topics, given the fact that as much as it's going to be a difficult environment and there will be a lot of work ahead of us, there also will be some unique opportunities potentially. Next slide, please. So my background certainly came from the supply base, spent a number of years on the forecasting side, but then also, the past 3 years led strategy here at OESA. Next, please. At OESA, we have fortunately over 500 member firms, and as a result, we have a unique opportunity then to survey our members. And so I'll share with you some of these insights. Next, please. So the market outlook, we'll jump right in. The Wall Street Journal does a monthly survey, and I knew that Paul would obviously give us a great recap here on the economic outlook. But what I wanted to just share is that the Wall Street Journal survey is about 60 economists every month. And so when do you expect the economic recovery to start? Almost evenly split, third quarter and fourth quarter. So a pretty strong direction there. Next slide, please. But I think what Jeff alluded to and what Paul also mentioned as well, the idea of what does that shape of the recovery look like? Certainly, when asking this group of economists, effectively, the majority of folks indicate that V-shaped recovery is effectively what we'll see. But again, almost evenly split, with that U-shaped recovery being equally equal share of folks. I'm sorry, can you go back, please? The point here simply is that we're looking at an even split. The impact here, though, and the question is the magnitude of change that's required in order, given the fact of what the recovery looks like. In a V-shaped recovery, there may be some quicker changes in implementation, that can be implemented that will effectively get organizations and suppliers back to a strong position. But ultimately, what we're seeing then is in that U-shaped recovery, where the impact is extended, it's going to be that much more painful. It's going to require even greater scope in terms of greater changes in terms of strategies in order to then be successful here thereafter. Obviously, a W-shaped recovery is certainly something that would be that much more challenging to contend with. Next, please. So we've done some weekly surveying of our members, and here this is from last week's survey, and regarding production here in the U.S. And so we asked our members, so have you changed your production in response to the announced OEM shutdowns or decreased demand? Well, certainly what we see here is that the vast majority have idled facilities. 50 to 60% have idled facilities, with another 20 to 30% have slowed production significantly. And so what we're seeing is that in the U.S., clearly 80 to 90% of all supplier capacity has been idled or dramatically reduced in terms of operations. And then in terms of those operations affected from today, how long are you planning on idling for? we saw this spike as of April 6th. And so we saw this impact here, over half, 56% of respondents indicating that, over 2 weeks. And so it was a much longer window of this period of being idled for. So what's interesting here, though, is that we've seen this a little bit of recovery in terms of the idea that there was a bit of a positive direction, right? Seeing that, okay, we were working toward restart, but obviously that has all changed. And so what we've seen here is there was another question that we had asked our members regarding those restart dates, and the vast majority of folks were banking on, or certainly anticipating, a May 4th start, in terms of getting back to production. What's challenging here, though, is obviously when we look at, certainly a couple of manufacturers have already begun those efforts, but the issue is that, as Jeff highlighted, and as we've heard from our other speakers, the supply chain is remarkably complex, and certainly there are many, many steps in order to make that to bring that to fruition, to bring that up online. Next slide, please. So when we think about some of the biggest challenges, we see here that, what are your biggest challenges heading into the restart? Number one, accuracy of customer startup times. And so this is really what's come back to this challenge that we're facing here. The idea is that a 1 week time, a 1 week shift, a 2 week shift has huge implications in terms of securing sufficient materials, securing sufficient talent in terms of operators and the rest, securing sufficient PPE, levels of protective equipment, and then ensuring across a whole host of these different areas. So this represents a significant constraint of the greatest issue that our members are facing. Moreover, then, accuracy of customer release volumes. And this is a really important one, because when we think about it, we know that the industry is going to begin at very constrained levels of production. So we're going to be looking at very low utilization rates. And so as a result, it's going to be very inefficient. It's going to be very costly, obviously, to comply with and ensure that all suppliers, manufacturers across the supply chain are complying with the new health and safety protocols. So that is kind of the top items, but then it becomes that much more complex when we think about shelter-in-place mandates. And the idea is that we know that supply chains are incredibly complex across the U.S., but then certainly across North America. And this is where the Mexico piece is especially important. Obviously, as we saw earlier in Kristen's content there, in terms of imports from the supply chains and the countries that supply them, very, very important that across North America that we have continuity of the supply chains at the same time. So that's a significant one there. I guess a couple other key points. If we look to the top right, we see comments there. And the comments, the verbatims, indicate that a number of hourly workers have deferred to stay home to collect unemployment based on the new stimulus proposal. And so this is another issue where there's some meaningful challenges ahead. That said, I think most responses indicate that in terms of protocols, that's something that's pretty well in hand. I think the idea of communicating those and ensuring that operators are feel comfortable that it's going to be a safe environment is really important. I think the last piece I'd highlight is logistics. Logistics is going to be a significant challenge from the standpoint that there are many smaller 3PLs that may not have been able to make this gap, and so there are going to be some challenges there. And so it's going to be a question of triaging these items here on this front. Next slide, please. So this is a slide that we've been producing for a number of years, and the idea here is that we go back to the Great Recession in 2009. Thereafter, Jim just set it up here. The dark blue line represents North American production relative to the red line, which is North American sales. The gray line to the right of 2009 indicates estimated break-even levels for suppliers. So this is part of our OESA supplier barometer, and from the first quarter of this year. And so what's interesting here is we know that historically there's been this gap After restructuring and after the Great Recession, there was a significant gap between break-even and production levels, which contributed to a very strong level of profitability and performance. What we've seen then is over time, we've seen the gap narrow. And so that represented about 1.7 million units here at the beginning of this year, with that median break-even level at about 15 million units. What we've seen now is certainly under a reset for North American production here in the low to mid 12 million unit range is millions of units below that estimated break even from the start of the year. And so what that reflects, clearly there's going to need to be some significant actions to contain costs, but then obviously to continue to ramp up and move forward. Next slide, please. So if we look and just do a quick review, we know the industry is inherently asset heavy, long lead, and so it's challenging on this front. It's full of boom and bust periods, so these peaks and valleys. And so what we're looking at this point, from the peak in 2016 at 17.8 million units of output, we're looking at a 5.6 million unit reduction, which would amount to about 32% decline from the prior peak. So that's a significant impact. We're looking at well over 25 assembly plants that would be idled as a result, or certainly that in terms of represents utilization that's underutilized. Okay, next slide, please. So what I want to highlight here is just simply another slide from our OEC supplier barometer from a year ago. And this simply highlights a number of different challenges that the industry was already facing. And really it comes down to the timing aspects of it. We know that continued changes in terms of engineering change orders and the rest. We know that there are already significant long lead production system delivery constraints. This has already been an issue that those items that move to the top right reflect the level of probability of occurrence, as well as the severity of the business impact. And so what's pretty striking here is that ultimately the industry is the supply base is under a significant amount of pressure. Next slide, please. So furthermore, if we look at kind of ranked order of production risks, we see that in the charts to the right, greatest internal risk to meeting customer production requirements. Again, going back to the third quarter of last year, lead times was the biggest issue. Labor issue, obviously not a factor here at this point, but the idea is that launches, and so these same types of areas, capacity is not going to be a factor now. But what's interesting is that supplier distress had already been a matter of course, had already been an issue of concern previously. And then if we think about your greatest supply chain risk in meeting customer production requirements, timings and timing delays, input good shortages, and I want to emphasize that these last 2 points, quality issues and financial distress. So if we think of financial distress, obviously an area of impact across the supply chain, but the other point is that quality issues. If we think about the scope of this restart effort, this is it's pretty extraordinary from the standpoint that it's never occurred in such a dramatic fashion, in terms of the overall scope of this restart effort. There may be a number of suppliers and across the supply chain where PPAP may be required once again in order to restart effectively. And so there are going to be some quality issues, and that's something that's important to be mindful of, and certainly is a consideration here as we continue to move ahead. Next slide, please. Next slide. So the industry's been in transition. It's kind of hard to believe. We go back to the start of the year, obviously at CES. Clearly, the industry has already been in a period of transition, and this is one of the other parallels, if you will, or the anecdote relative to this parallel paths of engagement. Obviously, trying to continue to focus on those programs that are profitable in terms of traditional offerings, but then at the same time looking at and embracing and being effective and competitive in these areas that represent ACEs. So next slide, please. But capital allocation has been a big challenge. Has been one of these big areas of concern. So certainly Alex Partners highlighted this, where there's a tremendous surge in terms of R&D and CapEx combined. So we look at a $25 billion spend in R&D and CapEx between 2010 and 2017, and that's grown tenfold between this 2018 to 2023 timeframe. And so obviously there continues to be this big push toward electrification for a variety of reasons. Obviously, the consumer environment is going to be a little bit different. It's going to be quite a bit different. So we'll see what that has to in terms of impact. But obviously, capital allocation in terms of the risk to this area is significant, and I think it does underscore a few different points, right? Obviously, the idea of opportunity targeting, but also due diligence. There are a number of players, a number of of emerging manufacturers that may not make this, that may not weather the storm, and so it's really important, obviously, for suppliers and industry stakeholders to be mindful of this. Next, please. Certainly, this only underscores the fact that the push toward electrification and automated driving is very costly. And so as a result, partnerships are certainly something that help to reduce risk, but also I show this simply as a means to underscore the fact that there may be additional, it may push players toward even greater levels of partnership here going forward. And so that's something to keep in mind. Next, please. So quickly, if we look at this impact here, the impact survey on automotive R&D between OEs and suppliers, it's interesting here that we see that over 20% of respondents, of OE respondents, indicate that they expect the impact to be between 1 to 2 years in terms of impact on R&D spending. In terms of the greatest, in terms of the area of impact, the main impact would be over half of respondents indicated that tech deployment delays would result. Additionally, then e-mobility technology, certainly the greatest area of impact as well. The vast majority, nearly all respondents indicate that there would be some type of reduction or as well as delay in terms of their development plans. Next, please. So this is just an example. So what does this look like? We're already seeing it. Ford and Rivian obviously working to, one, reduce expense, to partner and to share these costs to be more effective, and obviously then to also then establish mutual learning to potentially to obviously then scale in order to develop a stronger business case. Next, please. So if we look at electrification, it's interesting going forward. What are your biggest challenges or opportunities as the industry prepares for battery electric vehicle future? It's interesting because the #1 response for our members, new customer technologies are driving innovation. And so as much as this is a difficult environment right now, there's no question this is a crisis. And yet at the same time, some of the new ways of thinking, the new approaches that suppliers have been able to utilize and leverage during this approach and this run-up in terms of developing these new technologies and these, to supply these new programs has certainly been a boost and offers certainly some assistance as we look ahead here going forward. Third or fourth point down, we're currently capitalizing on BEVs. BEV programs are changing the way we do business, and so this is particularly important here going forward. Last point I want to make. It has to do with talent, and so we'll leave it there and we'll go ahead. Next slide, please. If we look at where that growth is going to come from, or where the anticipated time frame in terms of the first one here, how confident are you that global BEV production will reach 10% of total production? Effectively, we're looking at the vast majority of respondents indicating between 5 and 10 years or beyond. And then also, what are the implications in terms of a regional breakdown? Clearly, Europe and China far better positioned, with China effectively being the having the highest level of confidence where that's going to first occur. Next slide, please. So there are a lot of different players right now that are trying to enter in and trying to create a better mousetrap. A lot of these players are probably struggling. They may need capital, they may need expertise. It may actually open up a unique opportunity for suppliers to work with and partner, and actually also then find additional sources of talent when we think about how the industry is continuing to change and what that might mean here going forward. Next slide, please. So just to kind of emphasize, we know that certainly the industry continues to push from hardware towards software. And if we think of historically, vehicle, in the past couple of years, about 100 million lines of code per vehicle. That's already bumped up here more recently to about 200 million lines of code. And obviously to going forward, whether it's electrification or also then obviously looking at advanced automated driving, you're talking about up to 1 billion lines of code. And so software is going to continue to play an even greater role as a differentiator here going forward. And so even in the midst of this difficult time, there may be a unique opportunity. Next, please. So just to wrap things up, next. Obviously, look, the boom bust period is here again, and obviously you can anticipate that there will be a difficult time. It's going to require some. There will be some competition. It's going to require some difficult choices, and clearly there will be some winners and losers. And so that's likely to usher in the potential for consolidation on a number of different fronts, whether that's brands or programs. Or ultimately, though, if we look, there are some unique opportunities. Obviously, liquidity is going to be absolutely vital, and so it's important here to have this balance between kind of core versus these emerging opportunities. The crucial piece here on strategy, weather the storm, is going to be absolutely top of mind. But then ultimately, in terms of talent, is going to be crucial. Finally, if we look at M&A, obviously historically M&A was a unique situation in some cases in terms of looking at intellectual property. Right now, obviously valuations have come under pressure, and there may be some unique opportunities that also exist. Finally, I'd say looking at technology, this has already been an area where the supply base had begun to excel, and I think what's compelling here is this notion that by growing a partnering competency, there's a unique opportunity for suppliers to be that much more better positioned here to be successful and competitive here going forward. So with that, Bernard, I'll hand it back over to you. Thank you.
Thank you very much, Mike. And I'm getting back here on camera, and hopefully we are back in business. Okay, so I'd like to thank all of our speakers. Great presentations, great content, and boy, do we have a lot of questions, quite the list, and I think that's testament to how good your content was. Before we switch to that, Mike, is it okay to share your presentation with the participants?
Yes.
Okay, great. And I know we've heard from Paul and Jeff that versions of their presentations will also be made available. So I just wanted to let our participants know that, since we do have quite a few requests, which is understandable, there's a heck of a lot of content there. So to kick us off, Kristen, I'd like to go to you first, since you're the speaker from whom we haven't heard the longest. So for restarting production with the Detroit 3, the UAW is an essential partner there, and I'm sure that there are some pretty intense conversations taking place. What can you tell us about how that's going and what we can expect?
Well, those conversations are ongoing, and it's important to be careful not to say that they're negotiating, because it's very difficult to negotiate health. There are a lot of provisions already in the UAW contracts that address health and safety risks in the workplace. And the UAW is maintaining that they need to have greater testing available. And that the automakers' plans for early May starts, some had planned May 4th, were a little bit aggressive according to their advisors. So those conversations are ongoing. the automakers themselves have maintained that they're using these exact procedures in place in their facilities around the world that have already restarted and that they have had no issues. But there's great concern among the UAW workforce. There's a lot of things, a lot of hurdles we're going to have to get over here. People have kids at home and there's no childcare available for the amount of people that are going to be called back to work. And people are going to have to wear PPE and have training on the new coming to work procedures, and their jobs may have changed. You can't have the people inside the car installing the seatbelt anchors at the same time on the right and left. So, there's a lot of, thought to the slow, steady ramp up there. But the UAW wants to get back to work too. They understand the financial pressures that are ongoing, as well as their job to protect their members' health. We'll hear sooner, and probably before May 18th, how those are turning out. But testing seems to be one of the big hurdles.
Okay. And Kristen, your comment about not being able to have people simultaneously in the vehicle installing different elements brings to mind a question that was originally asked for Jeff. But with all these new procedures, all these new tactics, have we essentially reduced the industry's available capacity? And how will that play out?
Well, yeah, I'll take it if you want to also jump in, obviously, Kristen. I mean, we've effectively reduced capacity, at least in this short-term period, because number one, we won't be able to have the number of shifts most likely, and we'll have to have slower line rates to accommodate these new working conditions where you can't have workers in close proximity of each other unless in some cases it's going to be unavoidable, but in most cases I think there's going to be an attempt to keep that social distancing in place. I mean, I guess as a maximum capacity, you're still going to have those capabilities, but I think effective capacity has been greatly reduced, at least in this temporary period.
Yeah, Kristen or Mike, would you like to weigh in on that?
I think I agree completely with Jeff that our capacity is reduced, and capacity throughout the supply chain is reduced.
Yeah.
And the need for PPE is great. We saw the automakers and some of the big suppliers jump in the arsenal of health, and they're making ventilators and masks and shields and all sorts of things. And it's altruistic. They've been doing it for the healthcare system that very much needed it, but it's also self-serving that they're going to need mass quantities of PPE in order to restart production. Yeah. And it's a hot, sweaty environment, and your mask is going to get gross after a while, and you're going to want to replace that on a regular basis. And it's difficult to wear that PPE over a long period of time too. As Bernard had to wear one for a couple of weeks in our office when he returned from points on the other side of the Pacific Ocean earlier this year. It's not comfortable, but we wear safety glasses, we wear steel toe shoes. There's a lot of things that we're requiring workers to do inside the plants, and this is just one more thing.
Yeah, and Jeff, I'll bounce it back to you for one more perspective on this subject. Will demand be reduced enough that essentially limited capacity in the industry may not be a factor for a while? How do those play out?
Yeah, I know it's a balancing act. Clearly, I think when you look at it, it's what's the trajectory of the demand recovery, and then obviously that's why it's from an industry standpoint, the industry wants that volume back in, knowing that it's going to be a very slow restart, and we are starting to run into some inventory issues. So I think there could be some areas that are prohibitive of even if consumers want to purchase, they may not have the inventory available, at least during the restart. I think as we get into the late third quarter and into the fourth quarter, these things will take some time to get the new procedures in place at the plants. I think to test it, make sure it works, make sure we don't have relapses, things like that. Is there enough? Are there enough masks, equipment? All of this is an unknown factor right now. So I think that's a realistic concern, that we could see these trajectories kind of cross, and we may not have enough supply, but it's something the industry is going to have to work through.
Okay. Yeah, and as we switch a little bit to the conversation of demand, there's a question that I'd like to start with Paul on, and given who Paul's employer is, but what are we hearing, or what are the thoughts about a federal automotive market stimulus plan, whether it follows a similar pattern to cash for clunkers in the previous recession, or whether it takes a different form? But Paul, why don't we go to you first with that question?
Well, I haven't heard any discussion of that. I mean, from the perspective of the Fed of doing things like that. I mean, our biggest issue is to make sure that we keep the markets flowing, cash available. What we've done so far to buy back like mortgage-backed securities and treasury bills, so that banks and investors have adequate access to funds so that they can continue to do their business. That's our biggest challenge. The auto industry has already kind of done their own cash for clunkers with the amount of incentives that they're putting on the hood and what they're offering the consumer. I think the biggest challenge is going to be, will the consumer come back, and at what point? What is going to be the health of the consumer when this is over financially? Some people did, through the CARES Act and the Payroll Protection Plan, were able to, maintain a certain amount of income. But I think in the short run, at least until there's a vaccine or some kind of known ability to treat the disease, I still think consumers are going to be leery. So it'll be difficult to draw them off the sidelines if they don't feel like going out and doing these doing these types of transactions. And so I think that's going to be your biggest challenge. Not can we stimulate the market more. I mean, when you look at the trillions of dollars that have been put into the marketplace, I wouldn't call it stimulus. I would just call it a Band-Aid. What we've done with fiscal monies, we're approaching $3 trillion there. The Fed's going to have in excess of that into the game. So there's plenty of, if you want to call it stimulus, but there's plenty of liquidity out in the system. It's can you get the people out of their homes and willing to make the purchase, and do they need to? That'll be the challenge. As we all know, we've sold a lot of vehicles over the last few years. We had a number of 17 million. My pent-up demand model would indicate that we've pretty much used up any pent-up demand there was. And now we're looking at a number of months where we're going to have off-lease vehicles coming back in the millions. And so there's going to be plenty of other options for consumers to get through the short run if they decide they're going to either take on a new job because their other job they feel is too risky, or they try to do something else. I think that's going to be the challenge more than incentivizing the market.
Okay. Paul, just to follow up a little bit, one potential benefit to the industry may be, even if a stimulus program doesn't necessarily grow the market, but it does bring an initial wave of sales that provides liquidity, cash into the industry. I'm wondering, and Mike, you're kind of nodding your head. It seems like you might have some thoughts on that.
Well, I just think obviously right now, look, there's the first order of business is to get the ramp up, the restart in good order, and that's going to be a challenging thing. So it's going to take some significant time. But I do think that the potential would be there. Obviously, as Paul rightly says, certainly the used vehicle market does represent, a significant, alternative for consumers. But at the same time, in terms of, one could arguably have said the same about the initial the cash for clunkers program here last time, is that in light of wealth destruction and volatility in the stock market, there was a significant amount of concern, and yet consumers did come back, and they came back in a big way. Obviously, in terms of the first order of business is to really make sure that supply chains are learn to walk. Crawl, walk, run is the whole mantra, right?
Yep. Jeff, we had a number of questions for you on the situation outside of North America. One, can you share what you think might happen in South America, particularly Brazil?
Yeah, we've got steep declines in Brazil. There was a lag clearly of when they started to do any type of shutdowns and stay-at-home orders, but that's in place now. So likely going to be behind the rest of the world. I think more severe as well. So we're looking for pretty deep declines through the second quarter into the third quarter. And then we get into some level of a recovery pattern, but you're probably looking at numbers, and I don't have them in my head right now necessarily, but I think for the year, 40+% down, so pretty substantial declines.
Okay. Any thoughts on stimulus packages around the world? Are there models that the U.S. can follow?
Well, I think not unless we go back in history. I think the European model in 08, 09, the duration of that was longer. I think it had more of a staying impact in terms of volume, to hold volume or sustain volume level. So I think Western Europe is looking at a stimulus program probably similar to what they did in the Great Recession. So I think our expectations, our forecasts are calling for something in Western Europe as well. Obviously, we don't know the specifics, but I think we can look at the 08, 09 period to see that. I think to Paul's point about the U.S., just to chime in on that a little bit, while we're allowing for some increases due to a likelihood of a stimulus package, it really is going to be dependent on a lot of things, how this restart goes, how the relaxation goes, the consumers. In April, we saw a pretty substantial difference between age groups. So the 55 and older are the ones that stayed out of the market, stayed home. Really, not that everyone isn't staying home necessarily, but those are the ones that put off their purchases of vehicles. The younger buyer did not to the same extent. So I think, there's different pockets that are going to come back in at different points, and all of the intersections is really what's going to matter. And I think that's why we're not likely to see any announcement of a stimulus package or program until we get later in the year. And you have to have inventory. You can't put that in place and not have any vehicles to sell. So I think all of this has to kind of align.
Yep, correct. You also don't want to sort of show your hand, right? Because you may delay sales if consumers expect that there is a program coming that they could take advantage of. Those things don't work retroactively.
Yeah, no question.
If I could also join in on that about the age problem and the fact that people over a certain age are more susceptible to the disease and have more risk. Historically, most new car buyers are usually older. It's not, although the average age of a new car buyer is closer to 50 than it is to 20. They may buy vehicles for their children, things of that nature, but so you are looking at a sector of the population that is at high risk that's going to be slow coming back. One of the things, if you're talking stimulus, what you need is to create jobs. So if the plants aren't able to run and at full capacity because of constraints and things, I mean, this would be excuse me for being an economist, but this would be a great time when you got very low access to capital and very low interest rates to do something. You said look back in time. Well, look what we did during the Great Depression, jobs banks, infrastructure programs, those types of things that are working outside, working in areas where you are less susceptible and smaller groups. So there could be opportunities for the federal government to come in and create jobs in that manner that brings some of these people into the workforce, generates, helps them balance out and improve their balance sheets, and yet gets things done that have been discussed and much needed things that need to be done if we're going to move forward into even the next generation of automobiles, which is going to need new infrastructure, new roads, new connectivity, those types of programs, which would be as helpful to the auto industry and the plans that the auto industry has for the future as just incentivizing the purchase of an existing automobile.
Yeah, and back to your earlier point, this hits hardest the older population, but it's also that population that tends to have the assets to buy a new vehicle, which is increasingly becoming more and more expensive good. Hence, we have this sort of contradiction there as well. Kristen, we had a question for you regarding the difficulty of compliance with USMCA and some of the other trade issues that are either happening or around the corner. What, if anything, changes if we have a change of administration after the elections this coming November?
Well, I'd like to say a lot, but I'm afraid to say it's not much. You know, the negotiations, the last minute negotiations to get the USMCA passed in the Congress enabled the Democrats to get a lot of content into the bill and support the trade agreement. The AFL-CIO also supported the USMCA. So you've got, you know, traditional Democratic constituencies signed on that this is the way to go with trade agreements. So I don't think a change in the White House changes much on USMCA. You know, the enter into force will happen before the election. So, you know, I guess there could be delays in timelines or, you know, pushing out some of those out year targets, but that would involve negotiations with the other two countries as well. On China, I think China remains a focus of trade policy, no matter who is in the White House. The goals may be similar, but the tactics will certainly be different. I would expect a Democratic administration to be much more multilateral in their approach to China. And now we have these open talks with Japan and the EU and the post-Brexit UK, if that ever happens. I expect that we would see those continue as well, but, you know, again, tactical differences, not different goals.
Noted, noted, okay. Mike, a question that I think best applies to your presentation, you know, but essentially you talked about break-evens and where we're at now versus past levels. How is it different that the volumes this year will not necessarily be a result of sort of a gradual volume decline, sort of a flow where we do continue selling and producing just at a reduced level, but we have, for all intents and purposes, production stoppage in North America? How does that make those break-evens more difficult to apply?
Well, I think the challenge is that there's not an opportunity to prepare for it, right? It's one of these where arguably the industry and the supply base has probably been, you know, in as strong a position as it's been in a number of years, and so that's, you know, been, you know, obviously with some exceptions, but I think the idea is that having so much uncertainty kind of weigh on the planning. Obviously, as I mentioned, you know, incredibly asset heavy, and so a facility that's not operating for a couple of hours is significant and expensive, and for that to go on for weeks and months is incredibly challenging. Obviously, again, all we can do is you know, prepare and plan, you know, to be, you know, we know that, you know, restart plans will you know, be, you know, effectively unveiled, and those plans though are going to then change as well, because we know that there are going to be some gaps, there are going to be some disruptions that happen, and so it's going to be really important to continue to be flexible, to continue to be adaptive, to ensure that the you know, production continues and can scale then accordingly.
Okay, thank you, thank you. Jeff, why don't we finish with a final question for you? But you discussed fleet sales and the impact of the current situation on that. And so is that as a result of a decline in rental fleet purchases? Is it more of a decline in the commercial fleets for deliveries, or just the overall economy?
Yes. It's a little bit of all of the above. You know, clearly deliveries have obviously picked up. You know, and so I think there's the potential there for some recovery in that type of fleet. Commercial fleet in general, you know, your contractors, they're now starting to go back to work here in Michigan as well as other states. So I think there could be some impact there in the near future. On the rental side, I think this is going to be a lag. So I think we're going to see the steep decline in rental activity continue for the foreseeable future, and that's going to affect the recovery of the fleet side of the market. So I think expectations, probably not 80% down, for the next couple of months, but north of 50% would be what we're currently looking at. And I think that could spill into the third quarter before we see any marked recovery. So it's more on the rental side, more on the commercial side, some government as well, but I think we'll start to see some initial recovery in the commercial and government side.
Got it. Thank you.
Mm-hmm.
Okay, well, we're Mike, did you want to weigh in on that? Okay, just making sure I'm all right, just making sure I'm not cutting you off, that's all.
Thanks.
All right, with that, we're just a little bit over our time. So I would like to thank all of our panelists. Tremendous conversation, and you just gave us a heck of a lot of content thrown in. It'll be an ever-evolving situation, I'm sure, so we will be in touch with all of you to stay abreast of the latest. CAR itself will continue to monitor the situation, and we'll be putting out our latest thoughts out on the website in various forms, and of course, this webinar series will continue. As I mentioned earlier, this webinar was recorded. The participants will receive an email as a follow-up with a link to the recording and so on. So with that, one more time, I'd like to thank all of our panelists for joining us. I'd like to thank all of our viewers for taking the time to join us as well and for the excellent questions that they provided throughout. So again, thanks very much, everyone, and have a great day.
Thank you.
Thank you. Take care.
Bye now.
Bye.